As expected, the Fed did raise their interest rate 75 basis points last week. I think the market had that pretty well priced in, knew it was going to happen, but it does indicate that the Fed is still concerned about inflation and where the economy is going. Last night we had elections, and here it is noon on Wednesday, and we still don't exactly know what all the results are. Those could take another 7 to 10 days, might have some runoff elections. So there's still a lot of uncertainty out there as we look to the future.
Yeah. Well, moving on that note, the future, what's your outlook on the future?
I would describe my mood as cautiously optimistic. There's a lot of moving parts in this whole thing. The key to it all right now is inflation.
Yeah. So
the Fed is looking at inflation. They've got their foot on the brakes. They're trying to slow the economy down to keep prices from running away. If you look back in history, back in the 70s, 80s, there was a phenomenon called the double dip recession where the Fed maybe took their foot off the brake a little too soon. We went back into a recession, so I know Chairman Powell does not want to be the guy who does that and puts us into a double dip recession. In the housing market, what's fascinating about this is we've talked about this before in some of our bridge builder slides, about the shortage of housing that already exists in this country. So for the last 2 decades, we really have had a supply problem in housing, which causes all this demand, right? And in 2020, 21, people are fleeing to the suburbs, interest rates are extremely low, they couldn't build houses fast enough.
Yeah.
Now that rates have ticked back up, that's actually caused the home builders to slow down again, which only exacerbates the housing shortage problem.
Yeah.
So that's why I would say I'm cautiously optimistic. The CPI number is going to come out tomorrow, so we're going to get the latest and greatest view of what's going on with the Fed and the interest rates. And again, we've talked about this before. When we start to see inflation ease, you'll start to see the Fed ease. To what degree, to how much, is kind of yet to be seen. But CPI will come out tomorrow. Consensus, or the opinion I hear right now, is that the Fed probably begins to ease in December, maybe a 50 basis point increase instead of 75. And some have even said that could be as low as 25 basis points in the first quarter of next year. So as the Fed starts to take their foot off the brake, that's what everybody is looking for, is what they call the pivots. So specific to the mortgage market, there's actually a phenomenon right now where if you look at the spreads between the mortgage-backed securities and the Treasuries, so a lot of people in our business like to look at the 10-year Treasury and say, oh, well, if the 10-year Treasury goes up and down, that's what causes mortgage rates to go up and down. And they are correlated, but that's not exactly why that happens, right? And so right now, the spread between mortgage-backed securities and Treasuries is as wide as it's been in a long time. And that's because those two products actually have different things that drive their prices. And with the uncertainty that's out there right now with the economy and the recession, if there was a recession, does that mean people aren't going to pay their mortgages? Or if rates go down, does that mean all these people that are getting mortgages today are going to refi? So because of all that uncertainty, that spread has gotten pretty wide. As soon as we feel the Fed start to take their foot off the brake and they make that pivot, Steve feels that, we're probably looking about 100 basis point improvement in price, that happens as soon as the market signals, gets that signal that the Fed is pivoting. So, but let's just say if rates got back down into the 5s next year, okay? I'm old enough to know that 5% mortgage rates are awesome. I mean, my parents bought houses at 17.5%, right?
God.
So people would buy houses at 5% interest rates if they had confidence, right?